It's a common misconception that swing trading is a discipline that is pretty much reserved for institutional professionals or people with a lot of money. Well, the truth is, a systematic approach can be learned by virtually anybody out there. And in this video, we're going to talk about a pretty concise 4-step framework for swing trading. Now, a common piece of advice that we've heard is buy the golden cross. But such an oversimplified signal, they prove unreliable and they can lead to significant financial losses. Now, effective trading, it does not require an overwhelming number of indicators, but what is required is a structured and efficient methodology that can be integrated into a regular schedule. So first thing, we got to know what the trend is, and we're going to start on a daily chart. We're going to put on a 20-period exponential moving average, and the analysis requires answering one question. Is the price currently above the average, and is the moving average itself sloping upwards? If yes, the security is in an uptrend. No, it's in a downtrend. And if the price action is moving sideways without clear direction and whipping back and forth over the average, forget about that one, move on to the next instrument. Now, this initial assessment, it's just based on a single indicator. It's going to remove any sort of analytical ambiguity. The moving average, it's lagging. Okay, remember this. And the slope upwards is showing that the recent closes are higher than the previous. So if the closing prices start to be close together or they start to go below the opens, you're going to start to see a hook down in the average. So now we've got the primary trend. The next step is we need a pullback. And in an uptrend, this just involves the price retracing towards the average or a recent swing low or a recent previous price cluster. So drop down to a 1-hour chart to refine your entry. And you want to observe the MACD histogram, its momentum, for a bullish crossover. And that's going to be indicated by the histogram moving from negative to positive. And that entry candle occurs when a subsequent candle closes above the high of the candle that confirmed the crossover. Okay, this is the trigger candle. Our entry is quite simple. It's 1 cent above the high of the trigger candle. Our stop, 1 cent below the most recent swing low on the primary chart, which is the daily. Now, this method, it's based on objective price action and short-term momentum. The next one is we have to size our position, and it's a critical component of risk management. So you want to define your risk as a percentage of your total account equity. So decide what percentage. 1% of account equity, it's pretty conservative. 2% is more aggressive. Anything higher is very aggressive. And this calculation, it's fundamental to capital preservation. So as an additional confirmation, consider volume. If the volume on that trigger candle is higher than its 20-period average, it suggests participation in that trade. It's going to add conviction to that trade. And exiting with a plan. An exit plan has to be established and executed immediately after your position is entered by placing preset sell orders unless you're trailing your stop. So your first target, keep it simple for now. Set it at 1.5 to 1 reward to risk ratio. And after you hit that first target, adjust the stop loss on the remaining shares to the original entry price. Now you have no risk in the market. Target 2, pick the next major resistance level that's identified on the daily chart. And once that target is reached, the remainder of the position is closed. It's a rule-based approach to exits, and it is far superior to discretionary decision making. It takes the emotion out of your job. So quick recap. First, recognize the primary trend on the daily time frame. Second, isolate a pullback and an entry signal on the hourly time frame. Third, size the position according to a predefined risk model. That's the 1%, 2%. Fourth, exit the trade using 2 predetermined profit targets, a reward to risk and the next important level. And this systematic process can be implemented with a routine market analysis as you flip through the new charts that you're looking at. And if you found this approach to swing trading pretty valuable and simple, please consider subscribing. And although it looks simple, there's momentum behind this and you're trading with the trend. Talk to you soon.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPick's full risk disclaimer and privacy policy.